Once you understand what money really is and where it comes from, you will be changed forever. Most of us go to a job, earn a few dollars, use them on your needs, and if there's some left over, on wants. Have you ever thought about where that money comes from or consider what it actually does? The oldest form of trade was barter, my cheese for your apples. But what if all I have is cheese and you want wool? Well, then I have to trade my cheese for wool first and trade the wool for your apples. And this becomes very difficult very quickly when there are lots of resources to trade between lots of people. The thing that made it easier was the adoption of a medium of exchange. This could be anything seen as universally useful, something like grain since everyone needs to eat. This is a commodity-based medium of exchange. Not all commodities are equal. For example, the supply of grain fluctuates through the year. Just after the harvest, grain is plentiful and large amounts of grain is needed to buy things. And as the year progresses and grain is consumed, the value of the grain goes up. Less grain is needed to buy stuff. When the value of the commodity fluctuates, it becomes difficult to price things fairly. An improvement was the transition to a commodity whose supply does not fluctuate greatly. Metals are great for this, since mining is difficult, so the amount of metals won't increase rapidly, and likewise metal objects can be made and remade, so it never really goes away. A stable supply of useful metals as a medium of exchange makes fair pricing easy. Creating standard-sized lumps of metals as coins just made sense. Now today we use paper money, so how did we get there? Well, the first step is banknotes. As some people manage to amass and trade in huge sums of coins, it's difficult to carry around 500 pieces of copper or gold or whatever. It's easier to put those coins in a bank and carry around a piece of paper that can be exchanged for an amount of metal at the bank. So while we're still discussing commodity-based currency, let's talk about interest. When currency was based on a commodity, if I made you a loan, I was unable to use that resource until you repaid me. Well, this is a cost to me, so the fair thing is to charge interest. Now, think about those paper notes from banks that could be used to claim the metal stored at the bank. Some banker figured out that some people would never actually take the note to the bank to claim the metal it represented. The trick then was to create more notes than there was metal stored in the bank, because the banker could then loan out more notes and collect more interest. This is called fractional reserve banking. The reserved metal is a fraction of the value of the notes in circulation. If a bank was too greedy and loaned out too many notes, and enough people claimed the metal stored in the bank, there might not be enough and the bank would collapse. The banknotes would become worthless. It's an easy guess where greed is involved that this happened a lot. The creation of a national commodity-backed notes would solve this problem. Have you heard of the gold standard? By 1878, the U.S. had moved to a system of gold and silver-backed certificates, and the Treasury would take gold and silver and hold it in a reserve, and then issue notes or certificates. The Treasury would not create more notes than it had metals in reserve. And this created an easy-to-use banknote that was backed by a mostly stable commodity from an issuer that was unlikely to collapse. Each change, barter to commodity to coins to banknotes to national banknotes, brought with them improved trade and economic growth. Now there's just one more step to modern money, but before we get there, we need to talk about the money supply. The very simplest way to describe it is to say it's the amount of currency in circulation. I think to really understand, a model is helpful. Let's imagine a very small economy of 3 people, the baker, the butcher, and the candlestick maker. Pies, steaks, and candles are all $1. Okay, it's not a very realistic scenario, but this is a thought experiment. Let's imagine that everyone has their product and only the baker has $1. If the butcher wants to buy some candles, he can't, and likewise the candlestick maker can't buy any meat. The economy doesn't move until the baker makes a purchase, and once he does, he's stuck waiting for someone to buy a pie. Now the baker could spend 50 cents on some candles and 50 cents on some meat, but the butcher and the candlestick maker would be unlikely to do that because to them it would be a loss. And even still, they're still waiting for the purchase of the baker. Now, let's imagine that each of them has $1. Each can be the first to make a purchase, and no one is stuck waiting for someone else to move first. Trade flows, just a bit. Each purchase stimulates the next, but once a purchase has been made, the buyer still has to wait for someone to buy from him before the cycle starts again. The money supply here is only somewhat adequate. Finally, let's imagine that the 3 of them each have $3. Now, each of them can buy first, and still have some extra in his pocket for comfort, and multiple transactions are possible without much waiting, and everyone is busy working and trading. It's the good life. Now in all three scenarios, the labor and resources available was the same. The difference was the amount of dollars available for exchange, and this changed their behavior in a way that affected the economy. This illustrates the problem with a stable commodity currency. If some part of the economy is lacking the medium of exchange, they can't initiate economic activity. The gold and silver certificates of the U.S. Treasury were only issued as the result of gold and silver being stored with the Treasury. If the economy was lagging due to insufficient money supply, there was no way to increase the money supply. So for better or worse, a new type of money was created to address this. Here we introduce fiat currency. Fiat is Latin for "it shall be." Fiat currency has value only because we say it does. Now this isn't worthless money. Worthless is far from the truth. Fiat currency tells us something about the real function of money. It tells us what it is and what it does. Fiat currency can be created for any need at near zero cost. Let's skip for a moment who creates fiat currency. When fiat money is created, all that really happens is a record is made. It could be pencil and paper, but it's probably data in a computer somewhere. It doesn't even need to be printed. When fiat currency is created, it exists as information only, and this tells us the real purpose of money. Going back to our butcher, baker, and candlestick maker, what is really happening between these three? While it looks like they are trading resources, if you look a little deeper, you might see that each of them is providing a service. Pie making, candle making, butchering are all services. The reason for the money is to make sure that each of them is providing and receiving services from each other fairly. When the baker makes a pie for the butcher for $1, he provided a service to society, the butcher being the representation of society. The baker's possession of $1 is a record of the service provided. When he spends that $1, he receives a service in return. Now this notion raises some questions. If money is information, tracking contribution to and credit with society, when is it created? How long does it last? Who's responsible? Does it ever go away? Can it go away? Back to Treasury notes. Backed by gold and silver, the number of notes depended on the amount of metal in reserve, and the money supply could not grow to meet the needs of the economy. So, the Federal Reserve was created to manage and issue fiat currency. Now, much has been said about the villainous private nature of the organization. There might be an argument to be made that the forced conversion from a commodity to a fiat currency, where the value of the metals replaced, could be rearranged simply by creating more of the fiat currency as a kind of theft, but I don't intend to talk about that now. Let's add a reserve bank to our imaginary town. We last saw that each of them had approximately $3, and they were happily buying and selling amongst each other. The baker works out that if he had the money, he could build a better oven and have a more efficient business. But a new oven would cost $5, and that's an amount that's impractical to save up when there's only $9 circulating. So he does the business smart thing and takes out a loan from the new bank. The banker creates $5, gives it to the baker, and the baker agrees to pay interest on the loan. The baker goes on to pay the butcher and the candlestick maker a couple dollars each to help him build the oven, and the baker is pleased because now pie production is more efficient, and now he has to make loan payments. So he ups the price of his pies just a bit. And the butcher and the candlestick maker don't mind this because they now have extra money from building the oven. Over time, the baker pays back the $5 he borrowed and an extra $1 in interest. The reserve banker destroys the $5 that was created and keeps the extra $1 of interest for himself. That extra $1 is for providing the service to society of managing the money supply. In this model, the banker is a contributing member of society, and like everyone else, he'll spend his money receiving services from society. The banker charged the baker interest on the loan, but fiat currency isn't backed by a resource. So when the banker loaned the baker $5, the money was created from nothing and the lender was deprived of nothing. This makes the interest dubious to me, but let's try to rationalize it. In the imagined model, the interest was a way to pay the banker for the service of managing the money supply. Let's look at some real numbers. If you Google Combined Federal Reserve Bank's financial statement, you'll get these numbers for yourself. In 2011, the Federal Reserve received about $84 billion in various incomes, and that's mostly interest. Of that, about $75 billion was transferred over to the U.S. government treasury, and about $8.5 billion went into operating costs and dividends. That's the amount of money society paid for the service of managing the money supply. That's about $27 per person per year. Now, if that were a line item in the federal budget, that would be about 0.2%. For comparison, defense spending alone costs about $2,000 per year per person. So for a service as important as regulating the money supply, that seems pretty cost-effective. So maybe the Federal Reserve isn't the villain. That doesn't mean that there isn't a villain in the financial system. It will just be less obvious. If you want a clue, look at the interaction between the Federal Reserve and its member banks and you. As I record this, the Federal Reserve will make loans to member banks at 0.25%. The member banks will in turn loan this to you at 4% for a mortgage, or even as much as 30% on credit card debt. Now, the member banks aren't regulating the money supply. So what are we paying them so much for?